Hi, this is Keith Akada here at the Mortgage Reel with Fairway. I'm sure right now you're hearing a lot more chatter about this buy down, 2-1 buy down, a 3-2-1 buy down. It's dropping the interest by that first number. But who pays for this? And how is this going to come to fruition in my monthly payments? Well, here's a great education. So let's break this all down. So in this first model, we're looking at a traditional purchase. As you see across the board, these are all set on the same criteria. 750 purchase price, 10% down. So your loan amount here is a 675. The market rate as of November the 8th for my compliance people out there, 7.375 with there's the APR at 7.6. So in this model right now, a lot of sellers are more amiable because of the market to pay for and contribute towards the buyer's closing costs, real estate taxes, and insurance, right? So when we look at the payment break or the closing cost breakdown, we go right here to the fee detail, and you're seeing that in this model, we're able to successfully negotiate the seller to pay for a $10,000 credit towards closing costs. So that is very much what we see. And I would say for most of my purchases, I would say it's about 75 to 80% of the purchases, right? So in this buy down model, you can see everything's the same, 750 purchase price, the 10% down with the 675 loan amount. But there it is. We have the 5.375. So how does this come to be? Well, that 2-1 buy down, the first number, the 2, represents a 2% reduction in interest rate in that first year. So how does this look? We go into the payment stream, and you can see here in that first year, interest rates for the 2-1 or the 2% buy down is at the 5.375. Then in the second year, it's a 1% buy down to the 6.375. And again, once you get past that second year in the 2-1, then the remainder of the term, it goes back to the same interest rate that you would have started off at, and it goes through the remainder of the term. The reason why you see this one extra payment here at this is because it's always slightly less than the final payoff or that final payment. So there's the 2, and then there's the 1. So that's the 2-1 buy down. To make this a little bit more easier to digest, as I like to think about it, just because I'm super visual, here you have the note rate starting off at the 7.375. There's that 675 loan amount, right? Here's the total cost. So this is where we see what is it. So the reason why this number all of a sudden jumps out, why it's large, is because in that first year, the interest on a monthly basis is right here. In the second year, the interest saved is right here. So in buying the rate down, the interest is saved, but now this is over the 12 months. This is for the second 12 months. So this is 24 months of a total interest saved, which totals this amount here. So the lender is offering the 2-1 buy down, but someone still has to pay for the interest. Now here's the catch. It has to be paid for by the seller. So it's not something that we can have partially paid if you negotiate for that $10,000 seller credit, as we saw here in this first model. And then you say, well, we'll pay for the difference, Keith. Unfortunately, it has to be paid for by the seller. This is a Fannie Mae and Freddie Mac rule. So you have the buy down scenario here at the $15,998, and this is in the 2-1 buy down. So if we go back and we look at this, we go here to the closing costs. Well, if we go to the 2-1 buy down, this is where it shows up. There's that cost of the $15,998, and there's the seller credit. So the seller credit, we're negotiating in to offset it. So in the first model, again, we negotiated to have a $10,000 seller credit with the full offer price. In this model, same thing. It's the full offer price, but we're asking the seller to pay for the $15,000 of the total 2-1 buy down, right? So maybe it comes up as your offer being submitted, you negotiate $10,000, they weren't able to go up to the $15,000. But what I am seeing, this is a real life scenario, is you go into the inspection and the inspector finds things wrong with the house. What happens in a lot of cases with purchases, in lieu of repairs, it's negotiated that a fixed dollar amount is going to be credited in addition to the pre-negotiated closing cost that was originally part of the first offer. So now during the inspection contingency, that extra $5,000 could potentially get negotiated. Now, I'm not saying that's the best way to do that, but that is how some of my most recent purchases have turned into a buy down, because they're like, well, Keith, we're able to take on that buy down now because the seller is going to do it. We weren't sure if it was going to get accepted, so it was kind of luck and fate that it worked out that way. But here's where, if you have a great real estate agent, if the agent is very good and he can negotiate that going in, it's very clear that you have to understand how much this cost is going to be so it can be part of your initial offer, right? Because we know that if it has to be compensated by the seller in order to receive these type of lower monthly payments in the interest saved, then this has to be negotiated. So we know now that's with the 2-1 buy down. Well, there's also a 3-2-1 buy down. So what happens? We have the payment. You have their first year at 4.375, your second year at 5.375, then the last year at the 6.375. So that's the 3-2-1 buy down, right? And at the end, you go back to your same start rate as if you would have taken on the traditional offer and not had a buy down included. Well, in this same model, we have to look at it and say, okay, seller has to pay. Now, keep in mind, you're saving for a total of 3 years of interest being offset. So that dollar amount you can see here is at $31,501. So there's the savings in that first year, $1,291 a month in savings. Then in the second year, $882. Third year, we go back to the $450. So this is the 3-2-1 buy down. So the key thing here is this dollar amount that again has to be paid for by the seller. So when we look at the payment stream, there again, 4.375, 5.375, 6.375, and the remainder of the term at that fully indexed rate, as we like to refer to it in the mortgage world. Now, when you look at the cost, the same thing here in the cost, you're seeing that we're asking the seller to pay for this buy down. They're saying, okay, Keith, that's a huge amount. Well, let's just take, for example, this is a real life scenario. This just happened for one of my most recent closings. House has been on the market for over a month and a half. It was overpriced. Seller, unfortunately, is in a position where they have to sell. That was the luck of the draw. This can happen. So it was negotiated that the seller pay this. Now, the key thing here, the seller was actually, we found out from listing agent, already considering a price reduction. This came in as news after the fact, but that price reduction didn't hit yet. So they were already in the mindset that they haven't received any offers. They had 3 open houses. Now the seller's susceptible to some lower offers. So it was negotiated in this way. Why that could come up to speed here is if we look at a price reduction. So let me unhighlight these. Here you have your $750 full price offer, and we were able to get a $10,000 seller credit, right? So that's this traditional model. Let's go to this one here though. Now all of a sudden we see a $30,000 price reduction. So we went from $750 to now the $720. Of course, everything is going to lower. The 10% down is going to be calculated based off the now new lower sales price. But in this model, we weren't able to negotiate anything for the seller to pay for any closing costs because we went after the lowest price. So when we look at the payment stream, we're looking at $45.78. Well, why would we do this, Keith? Here, if we look at the savings on a monthly basis, you have the 2-1 buy down, you have the 3-2-1 buy down. This is that initial savings in that first year. So the first year for the 2-1 buy down, $882. $1,291 for the 3-2-1 buy down. From this model where we have just, again, $750, only a $10,000 seller concession, it's still a $217 savings by reducing the price, right? But in reducing the price by the $30,000, let's not forget that in this model here, we could have had the seller pay for the 3-2-1 buy down and effectively reducing our total costs. So if we had the $31,000 buy down for the 3-2-1, well, now that's allowing you to save that $12.91 in the first year. And then again, here in the payment stream, looking at this, look at how much the savings is because of that interest rate for 12 months at 3% lesson rate, 2% lesson rate, and 1% lesson rate. Because of that, now your monthly savings, you cannot deny that that looks a lot more attractive. So over the 36 months, you have a $9,500 savings over a price reduction that would have just saved the $6,600. So there's almost a $3,000 gain there. Now, if you wanted to get super technical about it, you could build in a 3% appreciation rate in the home. You've grown your asset by 9% in value, but you've saved this in interest on a monthly payment. Why to consider this? Well, let's kick the can down the road. They're talking about the recession, right? So please stay tuned. Watch my next video on how the Fed rate impact of all these rate hikes lead to a recession, and what happens during a recession, what's happened in history, and how that pressures rates lower. So you can definitely, in the call to action that you just saw pop up, click on that and it'll take you to my presentation on the recession impact on rates. But for this, let me get this out of the way here. You're looking at what is the savings and the total interest and PMI paid over 5 years. Here you're looking at 206, 239, 227. So obviously the 2-1 buy downs are going to be more attractive than either doing a $30,000 price reduction or sticking with the original $10,000 seller credit in your initial offer, right? So this is how to understand the 2 or the 3-2-1 buy down and what the impact is and how this is saving you on a monthly basis. So key thing is it has to be seller paid, right? So when negotiating, when working with a great loan officer, I give myself a plug there. The big thing is you want to make sure to understand what is the cost going into it. If it's a 2-1 buy down, we have to negotiate $15,000. If it's a 3-2-1 buy down, we have to negotiate the $31,000. It's important to understand that this has to be seller paid. If you negotiate in the traditional model, a $10,000 seller credit, you can't come back and say, oh, we'll pay for the difference. No, it all has to be seller paid. That's the rule of Fannie Mae and Freddie Mac. So it's important to know this up front so that you can be strategic in making an offer and understanding, okay, this is what's on the table. What Mr. and Mrs. Real Estate Agent do you think we could do in making our offer, right? The key thing here is just looking at how much more attractive is it to see that lower monthly payment than what it would be if you didn't even go for it or didn't even ask, right? So this is your education. Hopefully this has been very informative for you. If you have any questions or you'd like a model like this built out for your future purchase, please contact me. Thank you very much, and thanks for viewing. Take care.